In this video, we will discuss definition of financial leverage, its impact on business, level of risk in the business, grow business with financial leverage, conclusion of the topic. Now let's define financial leverage. Financial leverage is the use of borrowed money to finance the acquisition of assets. The impact of financial leverage on business. It allows investors to increase their potential returns on investment, but it also increases the risk of loss. The level of financial leverage is often expressed as a ratio, such as debt to equity or debt to assets. A company that has a high level of financial leverage is using a significant amount of borrowed money to finance its operations and assets. Financial leverage may be risky because the value of the assets decreases or the company is unable to make its debt payments, which can lead to financial suffering or even bankruptcy. It's important for investors to understand a company's financial leverage and the risks associated with it before making an investment. The application of financial leverage to grow a business can be a risky strategy, but it can also be an effective way to increase the size and scope of the business. By borrowing money to finance the acquisition of assets, a business can potentially generate higher returns on its investments than it would be able to achieve using only its own capital. For example, a business might use leverage to expand its operations by purchasing new equipment or real estate, or to fund the development of a new product or service. So, conclusion of the financial leverage is, it's important to carefully consider the risks associated with financial leverage. If the value of the assets that are financed with borrowed money decreases or the business is unable to make its debt payments, it can lead to financial distress or even bankruptcy. It's important to have a solid plan in place to manage the risks and ensure that the business is able to generate sufficient cash flow to meet its debt obligations.